Are you thinking about buying a home or just curious about how mortgages work? Well, you've come to the right place. In today's video, I'm going to break down some of the most important terms that you'll hear when talking about a mortgage. By the end, you'll have a much better understanding of what these words mean and why they matter. We'll cover things like APR, PMI, escrow, and more. So let's jump right in. Well, before we dive into the terms, let's start with a quick reminder. A mortgage is simply a loan that you get to buy a house. You pay it back over time, usually in monthly payments with interest. Now, let's talk about some key words that you'll hear when getting a mortgage. APR. You've probably seen the term APR on your credit cards, but it's also important in the mortgage world. APR stands for annual percentage rate. This tells you the cost overall of your mortgage each year, including the interest rate and some of the fee. For example, if you're comparing two loans that you might have a lower interest rate, but a higher APR because of the extra fees. That's why the APR is important. It helps you see the big picture when it comes to what you'll actually be paying over time. PMI stands for private mortgage insurance. This is a special type of insurance that protects the lender, not you, if you can't make your payment. You might have to pay PMI if your down payment is less than 20% of the home's price. So, if you're buying a house and you don't have a big down payment saved up, PMI could be added to your monthly mortgage payment. The good news, once you've paid off enough of your loan, you can usually cancel the PMI. Next up is escrow. An escrow company in California real estate acts as a neutral third party in the transaction, collecting and holding on to the funds and important documents until all of the conditions outlined in the contract are met. An escrow account, also called an impound account, is a special account where some of your money is held to pay for things like your property taxes and your homeowner's insurance. When you make your monthly mortgage payment, part of that mortgage payment goes into the escrow account. Then, when your property taxes or your insurance are due, the money is paid out of the escrow account. Escrow makes it easier for you because you don't have to worry about paying a big tax bill or insurance premium all at once. It's spread out over the monthly payments. A title company in a California real estate transaction is responsible for researching the chain of title, conducting a property survey, providing title insurance, establishing who holds title, managing closing, organizing funding. The title company ensures that the property's legal ownership is transferred from the seller to the buyer without issue. Every month you make your mortgage payment, it goes towards two things, your principal and your interest. The principal is the amount of money that you borrowed to buy a house. The interest is what the lender charges you for the money that you borrowed. At first, a larger part of your payment will go towards interest, but as time goes on, more of it will go towards paying off the principal. That's called amortization. Another set of terms you'll hear is fixed rate mortgage and adjustable rate mortgage, or ARM. With a fixed rate mortgage, your interest rate stays the same for the life of the loan. That means your monthly payment will always be the same, making it easier for you to budget. An adjustable rate mortgage, or ARM, has an interest rate that can change over time. For example, your rate might be fixed for the first few years and then adjust based on market conditions. This could mean that your payments can go up or down after the initial fixed period. The down payment is the amount of money that you pay up front when buying a home. Most lenders require a down payment of at least 3 to 20% of the home's price. The larger your down payment, the less money you'll need to borrow, which means the lower your monthly payment. Plus, if you put down at least 20%, you won't need to pay PMI. We mentioned this earlier, but let's dive into it a little deeper. Amortization. This is the process of paying off your mortgage over time through regular monthly payments. Each payment reduces the amount that you owe, but in the beginning, most of your payment goes towards your interest. Over time, more of your payment will go towards the principal, meaning you'll be building more equity in your home. When you buy a home, you'll have some closing costs. These are the fees that you pay to finalize the purchase of your home. They can include things like your appraisal fees, your title insurance, your escrow fees. Closing costs typically range anywhere from 2 to 5% of the home's purchase price. Be sure to budget for these costs when planning to buy a home. So, there you have it, some of the most important mortgage terms that you'll need to know. Understanding these terms can make the mortgage process a lot less confusing. Whether you're buying your first home or you just want to understand how loans work, knowing terms like APR, PMI, escrow, and more will make your decisions a lot easier. If you have any questions or you want to learn more about these terms or you're ready to apply for a mortgage, feel free to reach out. As your mortgage expert, I'm here to help you every step of the process. Thanks for watching.